Now I know property investment can be a divisive subject. I've seen it in the comments in some of my other videos, but in this video you'll have to bear with me because I just want to take a quick look at how we could get exposure to property, seeing it as a separate asset class, and how we could do that as small scale investors without much capital. Now why would we want exposure to property when, if we look at the last 20 years or so, house prices, when adjusted for inflation, have actually been pretty stagnant? And you could potentially say it's been even worse for commercial property, but after the doom and gloom of COVID, vacancies skyrocketed and many commercial premises lost a lot of their value. Well, the reason I want to look at them particularly in this video today is that it's certainly a sector, especially if you don't own your own home, that you're probably very underexposed to. And with interest rates seemingly reaching an inflection point, could we see positive property growth over the next 5-10 years? So hello, my name is Chaz. If you're new here, I go by the name of The Risk On Investor here on YouTube, and this channel is documenting my journey to building a £1 million investment portfolio. Now, nothing on this channel is financial advice. It's purely just me documenting what I'm doing, what I'm thinking about, and hopefully there's some interesting topics there for you. So before we dive in, I just want to make sure we're all on the same playing field with a couple of key metrics that I think we need to think about. The first is the raw nominal house price value. That's generally reported as a month-on-month change by Halifax and Nationwide. Now there are some other metrics for this, for example Zoopla and Rightmove have their own, and so do some of the other banks. And the second way we can look at this data is inflation adjusted data. Now for those of you who know some financy type terms, this is often referred to as the real prices. So you'd have the nominal price, which is the actual house price itself, but let's say a house price went up 2% nominally in a year. Now that could be a £100,000 house going up to £102,000 in value. Now if inflation is also 2% that year, we would actually say that whilst nominally the price has gone up, its real price has stayed the same because we take away inflation from the house price because theoretically everything is going up by the same value. Now obviously there's a lot more nuance to it than that, but that's the general idea. And the final metric I think we need to be aware of is the house price to earnings ratio. So this is particularly important for residential property, as the majority of first-time buyers and younger buyers are buying property with a mortgage. That means you're borrowing a large sum to go with your own deposit. Now theoretically, the higher the price to earnings ratio, the less affordable a property is. So for example, if a house costs 10 times your average salary, it's going to be more expensive month to month for you to service any debt you have to go with that than if the house is 5 times your salary, for example. Now the house price to earnings ratio isn't a rock solid metric, but it's a really good metric for looking at the general affordability of a market. Now I want to just quickly illustrate why house price investing has been so profitable for so many people over the last 20, 30, 40 years. And it really all comes down to leverage. So when we think about an average residential house that you or I might buy to live in, you can actually get a lot of leverage very, very cheap compared to most other forms of leverage. So for example, if you're a first-time buyer, you might have a 10% deposit for a house. So let's say you were looking to buy a £200,000 house, you would have £20,000 which you would put towards the purchase of that house, and you would borrow the remaining £180,000 from the bank. You would then own an asset worth £200,000, but the bank would have a charge on that asset for £180,000. Now here's where the magic could potentially happen. Now you're effectively leveraged on that house 10 times. So that means with £20,000, you've bought £200,000 worth of exposure to the property market. So if house prices go up 10% over the course of a year, you actually get 10 times 10% or a 100% return on the money that you invested. So going back to our example, that £200,000 house would become £220,000. So our £20,000 worth of equity from our deposit is now actually worth £40,000, so a 100% return in 1 year. Now, vice versa, the opposite can happen. If house prices go down 10%, that would wipe out all your equity. If it went down further than 10%, you'd be in what's known as negative equity. And this exposes a key fundamental working of how buy-to-let works. In my opinion, most of the returns from what I've seen are made in the capital appreciation of properties rather than the month-to-month cash flow. Now, whilst you can take out really high leverage on a residential property, if you wanted to take out, say, a buy-to-let mortgage, you can't take out quite the same amount of leverage, but you can still leverage yourself up around 4 times. So most buy-to-let mortgages, you'll generally need about 25% deposit, and the remaining 75% can be borrowed. Now, buy-to-let mortgages are also typically interest-only mortgages because that reduces the monthly repayments, but it does mean that you're not paying off the capital that you've borrowed. So for the term of the loan, the bank will maintain a set fixed value of debt against your property. So just to show you how that would work, I've put together a really crude spreadsheet list here that you can look at, and I'll pop on the screen in front of me. As you can see from that spreadsheet, I've made the assumption of a £200,000 house. So if we need our 25% deposit to get our buy-to-let mortgage, that would be £50,000. Plus you'll need a few £1,000s for legals, maybe a lick of paint here and there as well. So let's say you're all in for £55,000. So I've made some assumptions for rent, mortgage rates, all that kind of stuff, which you can see there on the screen. And you can see that for £1,000 worth of rent, the actual free cash flow after all the expenses are taken off is only around £160 a month. Now that's less than a 4% return on your capital, which is actually quite small. And I think it illustrates perfectly that most of the money is actually made in buy-to-let property from the capital appreciation rather than the cash flow it generates month to month. Because like we said earlier, if house prices go up, you're leveraged at 4 to 1 with that buy-to-let mortgage. i.e., if we get a 5% increase in house prices, you'll get a 20% return on your capital. Now obviously the capital appreciation is just paper gains until it can be realised in some way, and there are a couple of different ways to realise that in buy-to-let. The first is to remortgage, so i.e. take out a mortgage for a greater amount. Now that might reduce your cash flow from the property every month, but it might free up some of that money in a fairly tax efficient way. The alternative is to sell the buy-to-let. That way you might be able to realise more of the capital appreciation, but there are tax implications available on that. So for example, you might be charged at 18 or 28% capital gains tax, depending on your tax bracket. So now we know how buy-to-let works from a residential side. I actually want to think about what your exposure to buy-to-let is and what the current scenario is. So firstly, if you already own your own home, either mortgaged or if you're lucky enough not to have a mortgage, unmortgaged, you already have a very significant exposure to UK residential property. So you first need to ask yourself, do you want more exposure to that? So put aside any preconceived thoughts you might have about property investing, for example. If you were looking at it purely from an asset allocation point of view, would you be happy with a larger property allocation than you have currently? Now, if you have a mortgage and we're thinking about asset allocation, you need to think about the total value of that asset, not just your ownership of that asset, because you're leveraged up to having the full exposure of that asset. Now, for me, I'm not sure I would be comfortable with more residential property exposure, but there are other forms of exposure to property in the UK, namely commercial. There are also different tax advantages to commercial property over residential property. So, for example, you can hold commercial property within a SIP, so your self-invested personal pension. And as far as I'm aware, you can't do that with residential property. So that means capital gains and income is taxed differently to how it would be if it was outside of that pension wrapper. But again, in my opinion, this suffers from the same problem if we're small-scale investors like I am, in that if you don't have the capital to put up in the first place, you still can't achieve having that residential property or commercial property. So I just want to switch my attention to what is potentially the opportunity that I've seen. So I alluded to it earlier, but in the February monetary policy released by the Bank of England, they actually note something different from the last report, which was November. And that main difference is the projected interest rates going forward. So in November of 2023, the projected interest rates going out into 2025 and 2026 was at around 4% for the UK. So this is what financial markets were projecting. That's dropped by almost a whole percentage point in the last few months, down to around 3%. And so that suggests that interest rates might actually start to drop away a bit quicker than was initially thought. And lowering interest rates will slowly feed its way through into the lending markets, where we can see mortgage interest rates continue to come down. Now, as mortgage interest rates come down, it means that for the average person, you and I, if we remortgage or take out a new mortgage, we're taking those out on a lower rate. And that means our monthly repayments will go down, and theoretically that would boost your affordability for more expensive houses. Now, there's obviously lots of nuance in there, but if we follow that to its logical conclusion, if people can afford more on the same salaries, people will tend to stretch themselves, and therefore there could be higher demand for property going forward. Now, in my opinion, I think we're starting to see the first seeds of this come out. So whilst there's been some negative house price growth recently, that seems to be turning around. And that's not just in the residential sector as well. Through COVID, and especially towards the end of COVID, we saw an increase in vacancy rates for commercial property. And so I'm going to flash up on the screen a number of charts for some different what are known as real estate investment trusts. And you can see in 2022, the majority of them took between a 30 and a 50% haircut, depending on the exact REIT and depending on what it was invested in. So with affordability for residential mortgages potentially going up, that either means more cash in people's pockets when they remortgage, or it means house prices will continue to go up. Elevated spending could also be good for the economy, which might mean a lower vacancy rate for commercial property. Now, I think I would personally much rather invest in commercial property than residential if I needed to, and that's because I've got that residential exposure with my own home. Now, fortunately, commercial property is much more common to see in REITs, which are real estate investment trusts, than residential property is, and you can buy these on many investment platforms. So, for example, I'm a big fan of Trading 212, which is a commission-free platform here in the UK. I believe it's available in a few other countries as well. And all the REITs that I flashed up earlier are all available on Trading 212. And you'll see that they've taken a large haircut recently, but vacancy rates are now starting to drop, which suggests demand is picking up. Now, not only could this be good for the appreciation of the share price for these REITs, but it also means that the current dividends, which are hovering between 5 and 10% for most of the ones I was looking at, are potentially quite stable and quite safe for a couple of years going forwards. Now, if you're new to the world of REITs, there's one thing you should probably know about them, and that's generally that they're sector specific. So that might mean that a REIT specialises in buying structures that can be used for supermarkets. So they might already be kitted out with a large car park, there might be refrigeration capacity, there might be bakery sections in the building and things like that already. And so supermarkets are generally going to be good long-term tenants for these structures. And so that should give confidence in a regular cash payment coming out of these REITs. Commercial licenses also work different to residential licenses, where generally the onus for maintenance and repair is on the commercial tenant rather than the landlord of the property. That can mean fewer sudden shocks in terms of capital outlay required for repairs and maintenance. But as I'm sure you've already thought through, commercial leases are therefore much more complex, and whilst you don't always see such a high turnover in terms of new tenants for commercial premises, they can also remain dormant and vacant for quite a long while in comparison to residential units. Now, I haven't personally invested in any of these myself, and I'm just really going to be keeping an eye on them, especially over the next 6 to 12 months as the market continues to potentially pick up as interest rates start to get cut. But if it's something you're interested in, then all the REITs I've flashed up are UK based. Now, the reason I've picked UK REITs over further international ones is generally there'll be an extra tax on your dividends, even if it's bought within an ISA. So for example, if you buy a US REIT, there's usually a 15% withholding tax, which means you get 15% less of the dividend that's released by these investments, and they generally pay out via dividends rather than capital appreciation. So that's certainly just something to watch out for. Now, if it's something you're interested in getting involved in, I'd really recommend the platform Trading 212. It's who I use for my ISA account. So an ISA account, for those of you who may not be aware, is a tax-free wrapper here in the UK. So that means anything inside that wrapper is free of capital gains tax and dividend tax. And Trading 212 are also doing an offer at the moment where anyone who signs up can get a free share worth up to £100 if you use someone's referral link. So even if you don't plan on using Trading 212 as an investment platform, it's well worth doing just to get the free share. You can always sell it again, take the cash and withdraw. So if that's something that interests you, I'll leave my link down in the description below. And as full transparency, I would also get the same free share that you get, so it's a win-win for both of us. So I'd love to hear your thoughts on property. Is it something that you invest in? Is it something you'll consider investing in? If you are you tilting more towards the residential or the commercial side? Sometimes it can be a bit of an echo chamber that people in, so it'd be great just to hear your thoughts to make sure that I'm not going crazy and just seeing very specific things. And as always, thanks very much for watching.